In 2008, the intricate and often invisible machinery of the global financial system shuddered to a halt really suddenly. Banks, the very pillars of commerce, suddenly stopped trusting each other. The markets where they borrowed and lent money overnight, essential for their daily operations, simply froze solid. This tremor at the highest levels of finance did not stay there. It cascaded downward with breathtaking speed, reaching the main streets and industrial parks where the real economy lives and breathes. Small businesses, the vibrant heart of local communities, were the first to feel this seismic shock. They operate on a foundation of trust and consistent cash flow, and when that foundation cracked, their world began to tremble violently. For the corner store, the family farm, or the local construction company, the crisis was not an abstract headline, but a sudden and existential threat. When the banks, grappling with their own internal crises, abruptly pulled back on lending, this essential rhythm was broken. The reliable lines of credit that owners depended on were suddenly cut. The cash flow that was their lifeblood was severed. For many, this meant making impossible choices, letting go of loyal staff, selling off critical assets, or, in the most heartbreaking cases, closing their doors for good. The shockwave moved with an unforgiving swiftness, leaving owners with little time to react or prepare for the new reality. A loan application that was pending approval 1 week was flatly denied the next, with no clear explanation. A business credit card that was used to manage monthly expenses was suddenly maxed out with a drastically reduced limit. These were not just financial inconveniences. They were direct blows to the operational capacity of the business. For a small manufacturing firm, it meant being unable to buy the raw materials needed to fulfill a large order. For a restaurant, it meant struggling to make payroll at the end of the week. The crisis demonstrated just how deeply intertwined the fate of small businesses is with the stability of the larger banking system. The period immediately following the financial freeze was one of deep uncertainty and painful adjustment. To truly understand the magnitude of the change that 2008 brought, we must first look back at the world that existed before it. In the years leading up to the crisis, lending felt simpler. It was built on personal relationships and local knowledge inside community banks and credit unions serving towns and regions. A business owner could walk into their local branch, sit with a loan officer they knew by name, and make their case use handshake photo. Decisions weren't just automated credit scores or algorithms. They came from a holistic view of the business and its role in the community. Local bankers had deep, nuanced knowledge of clients, seasonal cycles of a farming operation inventory, needs of a retail shop, the character of the business owner themselves. They could look past a bad quarter or temporary cash flow dip and see long-term potential. That relationship model allowed flexibility and common sense judgment, often missing from centralized systems. Credit was easier to get and loan rules were looser, so small businesses felt they had a trusted partner. But this era had hidden risks. Globally, the financial system got more complex and interconnected. Big investment banks created and traded sophisticated products, often mixing high-risk mortgages and speculative loans into packages. Mortgage-backed securities, collateralized debt obligations meant to spread risk, but often hid it. The web of deals produced risks few understood beneath a booming economy. For a while, the system seemed to work. Housing prices were soaring, and perceived risk felt low. Easy credit and rising asset prices filtered through the economy, making borrowing easier for everyone, including small businesses. But the foundation was unstable. The structure assumed housing prices would rise forever. When that proved false and housing faltered, hidden risks were exposed, setting the stage for the financial earthquake to come. When the housing bubble burst, the value of those complex, risk-laden financial products plummeted. Banks and financial institutions that held vast quantities of these assets on their balance sheets saw their capital evaporate almost overnight. This created a crisis of confidence that spread like wildfire. Banks became intensely fearful of the hidden risks on each other's books, leading to a complete breakdown of trust. They stopped lending to one another, and the entire system seized up. Faced with massive losses and an urgent need to preserve their remaining capital, banks took immediate and drastic action. They slammed the brakes on lending across the board. For small business owners, this sudden credit crunch was devastating. The impact was felt in several direct and painful ways. First, existing lines of credit were either frozen or significantly reduced. A credit line that a business had relied on for years was suddenly unavailable, leaving them scrambling to cover payroll rent payments to suppliers. In the wake of the crisis, governments and financial regulators around the world took decisive action to prevent a similar catastrophe. Their goal: make the banking system safer and more resilient. A wave of new legislation followed, like the Dodd-Frank Act. Dodd-Frank rules were fundamentally reshaped for financial institutions. One major change: stricter capital requirements. Another, stronger liquidity requirements. Banks had to hold a much larger cushion of high-quality capital and maintain bigger reserves of liquid assets. The rules acted as shock absorbers, strengthening the system and reducing the chance of taxpayer-funded bailouts. Regulators tightened oversight of complex, risky financial products. The era of loose oversight and hidden risks was over, replaced by an emphasis on transparency and accountability. But there was a direct trade-off for borrowers. Safer banks meant stricter lending. Small businesses were hit hardest. Borrowing became more challenging and data-driven. Lenders demanded more proof and documentation. Nature abhors a vacuum, and so does the marketplace. As traditional banks tightened their lending standards and became more risk-averse in the years following the 2008 crisis, a significant gap emerged in the small business financing market. Many viable, growing businesses were suddenly unable to access the capital they needed from their longtime banking partners. This void created a fertile ground for a new wave of innovators to rise. A revolution in financial technology, or fintech, began to take shape, promising to provide the speed, access, and flexibility that many small businesses were desperately seeking. Online lenders and new digital platforms emerged, ready to serve the customers the banks had left behind. These fintech firms approached lending from a completely different angle. Instead of relying solely on traditional credit scores and historical financial statements, they leveraged the power of data and technology to assess risk in new ways. Daily sales data from a company's point-of-sale system, the payment history on their invoices, their social media presence, and online customer reviews. By using this broader set of information, fintech lenders could often get a more current and holistic picture of a business's health. For many small business owners, this speed and accessibility was a lifeline. A restaurant owner who needed a quick injection of cash to repair a broken refrigerator, or a retailer who needed to stock up on inventory for a holiday rush could now get approved for a short-term loan online and have the funds in their account within 24 to 48 hours. The convenience of applying online without the mountains of paperwork and long wait times associated with traditional bank loans was immensely appealing to busy entrepreneurs who needed to stay focused on running their businesses. However, this new world of fintech lending was not without its trade-offs. The speed and convenience often came at a higher cost because these lenders were often taking on risks that banks would not. Their interest rates and fees were typically higher than those offered by traditional financial institutions. The loan terms could also be shorter and the payment schedules more aggressive. This created a new dynamic in the market. Banks remained the preferred option for large, long-term loans for borrowers with strong credit, while fintech lenders excelled at providing small, fast loans for short-term needs. Many smart business owners learned to use a hybrid approach, maintaining a relationship with their bank while using fintech strategically for urgent capital needs, to balance cost and speed. Section 6. The adaptation small businesses learn to be resilient. The trauma of the 2008 crisis served as a powerful, if painful, teacher for an entire generation of small business owners. The experience forced them to fundamentally rethink how they managed their finances and prepared for uncertainty. The most critical lesson was the importance of building financial resilience. Before the crisis, many businesses operated with lean cash reserves, relying on their lines of credit to act as a safety net. After seeing how quickly that safety net could be taken away, owners began to prioritize building and maintaining a substantial cash buffer. Having several months' worth of operating expenses in the bank became a new standard of sound financial management. This new emphasis on self-reliance extended to their relationships with lenders. The crisis shattered the idea that a single banking relationship was sufficient. Savvy business owners learned the importance of diversification. Primary community bank, national bank credit union, trusted fintech lenders. This strategy ensured they were not overly dependent on any single source of capital. If one lender tightened its standards or pulled back, they had other options to turn to. Section 7. The lasting trends, a more diverse and complex toolkit. The shockwaves of 2008 did more than just push businesses to adapt. They permanently expanded the financial toolkit available to them. One big trend, the rise and normalization of alternative financing beyond traditional loans. Before the crisis, invoice factoring. Before the crisis, merchant cash advances. Afterward, those niche products became mainstream tools for many businesses. Invoice factoring lets a company sell unpaid invoices to a third party at a discount to get immediate cash. A merchant cash advance provides a lump sum in exchange for a percentage of future credit card sales. These instruments provided vital liquidity when bank loans were out of reach. The diversification wasn't just a couple new products. An entire ecosystem of alternative capital sources blossomed. A bank, a fintech lender, a crowdfunding site, an invoice factoring company, crowdfunding platforms, Kickstarter for product creators, Kiva for microloans, peer-to-peer lending sites connected businesses directly with individuals willing to invest. These new avenues offered more choice and flexibility. A small loan to test an idea, or a larger sum to launch a new product line, all without a bank's involvement. Alongside these tools, the crisis accelerated digital transformation in daily banking. Banks invested heavily in online and mobile platforms to compete and improve efficiency. Clunky, limited websites evolved into sophisticated digital dashboards. Small business owners could now manage their accounts, pay bills, deposit checks, transfer funds, all from smartphones or laptops. That saved time and reduced administrative costs, letting entrepreneurs focus on core operations. The digital shift has become a permanent, indispensable feature of modern business. However, the expanded toolkit also brought new complexities and risks. With more choices came a greater need for caution and financial literacy. Some terms and fee structures were confusing and sometimes predatory. A merchant cash advance, for example, could carry an astronomically high effective APR. Section 8. The 5 core lessons from the crisis. Looking back at the turmoil of 2008 and the evolution of the banking landscape, 5 clear lessons emerge for every small business owner. 5 core lessons. The first and most fundamental lesson is to always plan for tight credit. Financial crises and economic downturns are a recurring feature of the economic cycle. When they happen, banks will inevitably tighten their lending standards to preserve capital. A business must be structured to survive these periods of scarcity. Maintain a healthy cash reserve. Keep debt at a manageable level. Have a contingency plan in place. Hope for the best, but always prepare for the worst, because access to credit can vanish when you need it most. The second lesson is to combine the old with the new. Build personal relationships, but back them up with digital proof. The value of a local banker who knows you and your business remains immense. They can be a powerful advocate. But in today's data-driven world, that relationship is no longer enough. Banks and lenders require clean, clear, organized financial data to approve a loan. Use modern accounting software. Keep meticulous records. Be able to produce professional financial statements at a moment's notice. The winning combination is trust from a personal connection, fortified by the credibility of clean data. Third, speed comes at a price. Match the right tool to the right need. The rise of fintech offers incredible speed and convenience. It can be a lifesaver for solving short-term cash flow problems or for seizing a fleeting opportunity. But this speed often comes with higher interest rates and fees for long-term investments, like buying a building. Buying major equipment. The lower rates of a traditional bank loan are almost always the more prudent choice. Be strategic, use fast, expensive fintech for short-term emergencies, and slower, cheaper bank financing for long-term growth. Fourth, watch the policy signs. Rules and regulations from governments and central banks directly shape the lending environment. When regulators tighten capital requirements, borrowing costs tend to rise, and standards become stricter. When they implement programs to support small business lending, new opportunities may open up. You don't need to be a policy expert, but pay attention to the direction of financial regulation. Understanding broader trends helps you anticipate credit market changes and plan financing accordingly. Finally, the crisis underscored the immense value of investing in your own financial skills. Section 9. A new normal. The hopeful legacy of a painful change. The 2008 financial crisis was a painful and defining chapter, leaving deep scars on the economy and on the lives of countless small business owners. It was a hard teacher, exposing profound weaknesses in the financial system and showing how quickly the ground can shift beneath our feet. Yet, crisis often forces change, and from the wreckage of that period, a new and different world of small business banking has emerged. Today's landscape is a direct result of the lessons learned in that crucible. The system is, in many ways, safer. The tools are more diverse, and the business owners themselves are more resilient and more financially astute than ever before. The legacy of the crisis is a banking system that operates with more caution. The new capital and liquidity rules have made banks stronger and better able to withstand shocks. This stability, while sometimes frustrating for borrowers, provides a more solid foundation for the entire economy. The caution also created a void which spurred an incredible wave of innovation. Fintech lenders, alternative financing platforms brought competition speed and choice, giving small businesses more options than ever. This created a new normal, a hybrid ecosystem where old and new coexist. A small business owner today might use a community bank for their primary checking account, community bank for a long-term property loan, a fintech lender for a quick working capital advance, an online platform to factor invoices during a slow month, and a mobile app to manage it all. This is a more complex world, one that asks more of the business owner. It demands that they be smarter about money, more diligent in their planning, and more strategic in their use of credit. But it equips them with a more powerful and flexible toolkit to navigate challenges and seize opportunities. In the end, the story of what 2008 did to your bank is one of painful but necessary transformation. It was a wake-up call for regulators, for banks, and for business owners. The change was difficult, and the memory of the hardship should not be forgotten. But the change helped forge a safer financial system and a more resourceful and resilient small business community. The mix of caution and speed and of traditional relationships and digital tools that defines today's new normal is the hopeful legacy of that difficult time. It is a legacy that helps protect our businesses, strengthen our communities, and build a more durable foundation for the future.